Welcome back everyone to another stock review episodes. Today we'll be looking at yet another Russell 2000s. It's called the United Homes Group, or known as UHG. So without further ado, let's get right into it. So United Home Group, based on the chart right now, is actually the stock is experiencing a bear market ever since the year of 2023, and this stock actually went up to a very significant price of 30 US dollar approximation. This is actually a 160% growth, which is just one or two times. And right now the stock is just going down into a lower price range as low as 1.5 US dollar. And recently just going up and almost break these trends of downwards due to the crossover of the 50 EMA cross above the 150 and 200. And if this forms a clear uptrend of the EMAs, it might actually indicating a reversal for this stock market and showing a signal for short-term upward trend. So first of all, we'll be going through the revenues for UHG, and over here we can observe the quarterly results of the revenue. And although the company is actually making sales, it's just that the predictions, the predictability, as well as the revenue itself does not increase in a consistent form. And it's just that the form is very consolidated and more on a cyclical form. And as for the net income for UHG, is also in a form whereby it is less predictable and also showing sign of negative net income. Despite having the company making positive revenue, they just does not profit from what they are actually doing. And as for the free cash flow, the situation of free cash flow is actually pretty good during the year of 2022. It start to slide, showing a concern in terms of the reducing free cash flow. So right now we'll be looking at what does this company United Homes Group actually do. So it's actually a home building company in US focused on designing, building, and selling homes in Southeast Georgia, South Carolina, and as well as North Carolina. So what they do is they focus largely on entry-level and first move-up buyers, which consists of affordable and moderate price single-family homes. They offer both detached single-family homes as well as attached housing types. And they also use land-light model to reduce the risk and capital burden rather than owning all the lands outright. And they also have joint ventures for mortgages to improve sales and customer experience to generate additional revenue. And here you also mentioned some of the key risks or weaknesses, which is home builders are sensitive to interest rates, land costs, supply chain distributions, labor availability. So let's look into detail of their main streams of income. So first of all, the primary revenue is going to be their home closing or home sales. So this is one part of their largest revenue whereby they finish building homes, they sell them and record the sales revenue net of any discounts and so on and so forth. And second of all is going to be the sales of lots and lands. So they often owns and control lots, land parcel. So either directly or via option banking arrangement, they develop into finished lots for building homes or sometimes acquire lands through joint ventures. And thirdly is going to be their custom builds or attached and detached units. So this is beyond standard production homes. So they also done custom homes, different housing types, depending on the community as well as the needs for the people. And fourth is going to be their mortgage banking joint venture and related income to provide services to the buyers as an extra income, as well as acquisition growth and segment revenue via other home builders, and also expanding into additional geographic markets and also contribute. So now we'll be looking into the strength and weaknesses for this company. The strength number one is going to be the focus on entry level and first move up buyers. So they target affordable mid-range housing segments, which tends to have higher demand for the people than rather than buying a luxury home. And second of all is going to be land-light business model. By partnering with land bankers instead of owning land, they reduce their capital intensity and debt burden. And as for third, it's going to be their established regional presence. So which means that they are actually having strong base in South Carolina, North Carolina, and regions with population growth. And fourth is going to be their growth through acquisitions. So the expansion via acquiring regional builders and broadens their market's footprints. And they also have diversification via mortgage and also have legacy reputation from great southern homes. As for the weaknesses, number one is going to be their small scale compared to big peers. So they are much more smaller to national home builders like DR, Horton, Lenner, and Post. So meaning less bargaining power with suppliers and land developers. And second of all, it's going to be high dependence on one core market, which they also just focus on directly market to South Carolina, North Carolina, as well as geographic concentration exposure to regional economics. So third is going to be thin margins in affordable housing. So entry level housing is high volume, but low margin compared to luxury or custom home, which also rising inputs and can squeeze their profitability, which we can actually observe in their current situation from their net income, which is very unpredictable, as well as having certain numbers of losing in terms of negative net income. So recently we have the rate cuts being executed during September, and also being noticed that there will be further rate cuts within 2025 as well as expected in the year of 2026. So what is the effect of these rate cuts or falling of rates on home builders like United Health Groups? One of the first key is going to be the mortgage rates and buyers' affordability. So higher mortgage rates, meaning there will be higher monthly payments for buyers. So few people will be qualified and few people will be willing to buy. So lower rates will improve the affordability. Monthly payments will be low for most people. So it is boosting the demands. More people will be qualified for the loan and making more buyers to become active in this market. So second of all, it's going to be the cost of financing as well as debt servicing. So builders often borrow for land acquisitions, development, constructions. So if rates is high, the cost of the capital is very high, which reduce their profitability and also squeeze the margin. And due to the rate cuts, this may actually lower the cost of the company. So the third one of cost of carrying land and inventory is similar, whereby high rates will make carrying land more expensive and riskier. And we have construction costs, which although not always tied directly to interest rate, but rising often coincide with inflationary pressures. So the suppliers might raise price, and due to rate cuts, they might actually face a more opportunities because of lowering of construction costs as well as supply chains. So with high rates, buyer hesitates, and lower rates, demand tends to pick up because money is becoming more cheap. It's easy to lend, it's easy to borrow, it's easy to have to qualify a loan. So the activity of buying as well as owning a house is become more frequent, which will increase the revenue as well as demand net income of the current company. So after all, we can observe that this company is actually a home building company, whereby they also have diversification in terms of managing mortgage to provide services for their clients. And as for this company is that it is highly or so-called somewhat being affected by rate cuts to a certain level, whereby it's actually being observed that, hey, we are expecting rate cuts which will actually drive these markets to move higher due to cheaper borrowing as well as cheap money in the sense. So now moving on to the ratios, we'll be first looking at the profit margin, whereby we can actually see profit margins decrease since the year of 2023, which is also being reflected on the price actions on the stock itself. And as for the balance sheets, we have the net cash, whereby we can actually observe the is in a situation whereby they have more debts than cash. And that situation can also be reflected by the debt equity ratios, which is above 1 and is located at 1.6, which indicating they are actually high debt situation in this company. And also we have ROE of decreasing ROE, as well as reason one is less than 15%, as well as for ROIC in the form of decreasing, especially significantly lower than the 15%. Lastly, we will be looking at the economic mode score for the United Homes Group. And over here, we can actually observe the branding, loyalty, pricing power at 4, high barriers to entry at 5, switching costs at 5, network effect at 2, as well as economic scales at 5. So overall, the average score for the economic mode score is actually at 4.2, signifying a weak modest to narrow mode, which actually is very far away from having a wide mode, indicating that this company might actually be a very weak mode company. And in the long run, this company may face certain challenges in terms of their profit margins as well as their predictability. So overall, after looking at their financial status as well as economic mode scores, we can conclude that this market or this company is actually facing a problem whereby they are having less predictability as well as low profitability, and also having weak mode with high debts than their cash, as well as very low ROE and ROIC. So as for my view is that I would actually stay away from this company. And personally, if you are very interested in this company, you can further do your due diligence, understand what does the company actually do and what is in their inventory right now and what is their future outlook, and do your due diligence before you make any decisions on it. And as for me, I will currently stay away from this company until further quarters, which actually signifying and also represents that, hey, this company has increasing and more predictability as well as increasing profit margin in the future, and also turning their mode to become a wide mode by changing or having strong competitive advantage with more products in the future. So I guess that is all for this video. So this stock UHG can be a potential, but right now I just don't see any reasons of holding into this investment. So I hope this video helps you, and if you want to support me, you can click the thumbs up, subscribe to the channel, and I will see you guys on the next video. Goodbye.